This is Chris Cahill at 12 Points. Thank you for joining us. Today we're going to go over the Taxman Cometh strategies to minimize your contributions to the government. I'm really honored and thankful to have Jim Keefe, CPA from Lee and Crowley, on with me. Jim, you want to say hi to everybody?
Hey everyone, good afternoon.
Excellent, thanks so much. And again, apologies for the technological issues here. So this is my bio and background. I'll be really brief. I'm a partner here at 12 Points, attorney, CFP, chartered advisor in philanthropy, specialized in working with family-owned, closely held business owners, wealthy folks trying to make the most of their money and their legacy, and helping our clients define, discover, and live out their freedom. This is This is Jim. So Jim, give us a quick overview of yourself if you can.
Hey everyone, good afternoon. Jim Keefe. I am a CPA. My office is located in South Boston. I work with small and medium-sized business owners in a number of industries: real estate, manufacturing, professional service firms, and contractors.
Perfect, thank you. So we're going to spend today talking about taxation and the new world order that we're in here. So Jim, you want to just take us through what you're seeing as changes for this year and what we should be paying attention to?
Yeah, so in terms of changes, this past year, not a lot was accomplished with taxes just because of the political scene. I'm expecting this year with new budget trying to get through Congress that we're going to see a lot of changes. There were a number of tax provisions enacted back in 2018 as part of the Tax Cuts and Jobs Act that are set to expire at the end of 2025. So I expect this coming year, we're going to see some dramatic changes, or hopefully just extenders to keep some of these beneficial provisions in place for our business owners out there. A couple of these extenders that we're hoping to see pass would be an extension on bonus depreciation, bringing that back up to the 100% limitation, getting rid of the interest expense limitation rules, and changes in R&D expensing versus capitalizing. And then on the estate side, the estate tax exemption is set to drop back down to, I believe it's like 5 million. So hopefully that extension also goes through. But these are all, big what ifs at this point, and we probably won't know more until the end of the year if these get, put into a budget.
Yeah. And I would just chime in on that point there. Thanks for that, Jim. The reality from what I'm hearing, and I spend a lot of time with trust and estate attorneys, CPAs like Jim, focusing on estate planning. Most of the folks that I speak with all are on the general consensus that the exemption amount will not sunset in January of 26 and will in fact be extended. However, that hasn't been finalized yet, and there's the possibility that forces dictate and get in the way of that. So there's still a possibility that it reverts back remote, and we have a Republican White House and Congress, so this is certainly a highly anticipated project for them to maintain the high estate tax exemption amount. So we shall see where it goes. So where to next, Jim? Right now I'm looking at the screen that says W-2 employees.
Yeah, so just thinking about ways we can keep money out of the government's pocket. For an employee, you're very limited in what you can deduct on your personal return. So the question is, what can you put away pre-tax through your withholding through work? So I always say take advantage of every benefit your employer offers. I put myself through college not once but twice on the dime of my employer. So when your employer offers you a benefit, take full advantage of it. 401k, I'm sure all of you are familiar with a 401k. A 401k has multiple components to it though. Most of you see just your component to that, which is your elective deferral, how much of your paycheck you want to put into your 401k plan, which escapes present taxation, federal income tax and state income tax. There's also two other components that you may be a part of your 401k plan, depending on how your employer sets it up. There could be a safe harbor match, which means your employer matches a certain percentage of your elective deferral each year. Or there could be, in addition to that, or in place of that, a profit sharing component, which means instead of matching a certain percentage, they have discretion on how much they want to contribute to every employee's 401k based on a number of factors. Usually it's profitability of the firm. So I'm a big proponent of my 401k. I try to put as much as I can away, and then, hopefully my employer is also matching something on the back end. And most of your employer's plans will tell you whether or not what other options they have as part of the plan. A couple other pre-tax provisions that you'll see with most larger employers or even smaller employers. Health savings account. Health savings account is a great way to put money aside for medical and dental expenses that otherwise you would not be able to deduct. Most of us, if we've been in our house for a number of years, we're not really itemizing our deductions anymore because the standard deduction is so large these days. So by having an HSA or an FSA, we're able to deduct these medical and dental expenses that we can't otherwise get a deduction for. HSA is preferable to an FSA for a number of people because the contribution limits are more, put up to 8,000, I believe, into an HSA pre-tax. And what's great about an HSA, it's a savings account. It's not a spending account. So I've seen a number of people use this as an additional retirement tool. They have a little additional disposable cash to work with, so they're funding their HSA, and they're not necessarily drawing it down every year because there is no drawdown, use it or lose it provision. Whereas with a flexible spending account, you are going to see a use it or lose it provision, or a provision that says, you have, I believe it's 90 days next year to use your FSA. Other pre-tax benefits your employer might offer are child and dependent care benefits. For most people, if you have a child and you and your spouse are working and you send that child to a daycare, a summer camp, a before or after school program, and you're paying out of pocket, those programs all qualify for the dependent care credit. And there's two ways to deduct that. You can either claim it on the tax return itself and get the deduction on the return, or you can use pre-tax dollars contributed through your W-2, and then you would still mechanically fill out the form the exact same way, but because you already got the deduction up front through the lower taxable wages on W-2, you're not going to get an additional deduction on your return. But it's just another great way to pay for something with pre-tax money.
Perfect.
And then we talked about this slide for the last couple of years, but this is actually taking place this year. So starting in 2025, plans that were created after, I think it's October of 2022, must have, in order to be an eligible or qualified plan, they must have an automatic enrollment provision, which means once an employee meets the eligibility requirements, they're automatically enrolled in the 401k, and they have an elective deferral of 3% immediately. Then it's an escalating deferral. So that means the next year that 3% would have to move up 1% to 4%, and it would keep going up until 10%. Now, employees do have the option to elect out of this, but for plans to be eligible retirement plans created after October of 2022, they must include this provision. There is exceptions, of course, for plans not in existence for 3 years and employers with less than, I believe, 10 employees. But for your larger plans that have been in place for 3 years, and the reason it's 3 years, if 23, 24, 25, we're now in the third year for any plan that would have started in October of 22 or November of 22. Other item, there's a small business startup credit for employers that offer a retirement plan to their employees. A small business is defined as a business with 50 or fewer employees, and the credit is equal to the cost of administering the 401k plan. The credit does phase out for employers with 51 to 100 employees, so you could still get a benefit if you have less than 100 but more than 50 employees. In addition to the credit for the administrative cost, there is also a credit available for matching. So an employer that a small employer that chooses to match, via safe harbor match for their employees' retirement contributions, there's an additional credit they would be eligible up to $1,000 per employee. And then next item on this slide is just the increased age requirement for RMDs. So right now, if you're 73 or older and you're no longer employed by your employer that you have a retirement plan with, you are required to start taking RMDs. For myself, that's a little bit younger than some people. I'm not going to have to worry about that for a number of years, but when my RMD age is going to be 75, because that's going to kick in 2033. Thankfully, I still will not be 75 in 2033. Another item, treatment of student loan payments as elective deferrals for employer matching. So you've heard me say employer matching quite a bit already during this presentation. And employer matching, like I mentioned earlier, is based off their matching a percentage of what you contribute as an employee. Well, the Secure 2.0 Act added a provision to the code that allows employers to match student loan repayments. So if you have someone that unfortunately is spending a tremendous amount paying down their student loans and they're not able to put away as much as they'd like to their 401k plan or other qualified plan, these employees can self-certify to their employer what they've been paid towards their student loan, and the employer can then match based on that. There is some paperwork that the employer needs to collect, and this is a provision that they would have to add to their plan. So if your retirement plan doesn't have this provision, your employees can't take advantage of it. So you would actually have to go back and amend the plan to add this component if you wanted to offer this benefit. And it's a great tool in order to retain talent. If people are with prices of everything these days not putting away as much as they want to, and they're worried about paying down their student loans, a great way to say, hey, keep paying your student loans and we'll help you on the back end, save for retirement.
That's a great point. And what I would just simply add there as it relates to the RMDs, to go back to what Jim was talking about, if you're an employee of a corporation and you continue to work past your required minimum distribution date, so long as you are less than a 5% owner of the company, you can continue to avoid taking RMDs. So there's a benefit to those of you that continue to work. And you can continue to contribute and defer that way. So that's something to pay attention to.
A couple more provisions of the Secure 2.0 Act that I think are great and worth mentioning. So if you're a beneficiary of a 529 college savings account and for whatever reason you never fully took advantage or on that 529 plan, if there's any money left in that, you can roll over up to $35,000 over your lifetime into a Roth IRA. You're not subject to, as many of you may or may not know, in order to contribute to a Roth IRA, normally just doing a straight contribution to a Roth IRA, there are income limitations. The income limitations do not apply to this. And then it's a couple minor requirements. This plan, your 529 plan has to have been around for at least 15 years before you can take advantage of this. And you can't roll over more than what was contributed, I believe, at least 5 years ago. So they really don't want you rolling over appreciation so much as the original contribution amounts. Another item is a reduction in the excise tax on certain accumulations in a qualified retirement plan. So the RMD, R and RMD stands for required. The IRS requires you to take a minimum distribution once you hit the mandatory age. And if you fail to do that, they will penalize you for that. So prior to Secure 2.0, the penalty, that excise tax, was 50% of what your RMD was supposed to be. They've decreased it down to 25%. And if you do make the correction within 2 years, they reduce it even further down to 10%. So I've had a couple of situations where someone's reached out and said, hey, I just picked up a new client, their financial planner or so-and-so, they weren't aware they had an RMD, or they had an inherited RMD that they weren't aware they needed to draw down on, and start moving the wheels as fast as you can to make that correction, so you're going to pay a penalty, rather be the 10% than the 25%. And then another exception to penalties is there's an exception on early distributions from qualified plans for individuals with terminal illness. This was just one of the exceptions added to Secure 2.0. There are a number of other exceptions that were added to Secure 2.0. There's also an exception added for distributions taken for federally declared disaster areas. And this applies just to the excise tax. Distributions, if not repaid within a certain time period, would still be subject to income tax, but you're at least not going to get hit with that excise tax penalty for taking a distribution from a retirement plan, and you're not 59 years of age. So what are key considerations and options for taxpayers and their charitable giving? So high level, just talking about, when do we get the charitable deduction? When don't we get the charitable deduction? So most people that get a charitable contribution deduction on their return are itemizing at the same time. Federally, there's no charitable contribution with the standard deduction. A couple of years ago, you were able to deduct up to $600. That's gone. So you really need to be itemizing to get a charitable contribution. There's this concept, it's a strategy, it's called bunching. And what that does is say, hey, instead of giving $5,000 this year, $5,000 next year, and not getting any benefit because we're not itemizing, maybe let's put those all together and do it at one point in time and get that benefit in year two. So year one, I'll take my standard deduction. Year two, my contributions plus my real estate taxes, my income taxes, state and local taxes, mortgage interest, investment interest expense, all together get me over that standard deduction. So now I'm getting more bang for my buck with my charitable contributions.
Yeah, and let me just chime in here on this, Jim, just a question to ask you. So, as we talked earlier about the estate tax laws changing, potentially some of the other provisions of the Tax Cuts and Jobs Act extending, let's talk for a minute about the SALT limitations, right? Like that's something that really impacted a lot of us in Massachusetts, New York, California, et cetera. There's been discussion about possibly modifying that going forward. Can you just opine a little bit on that, if you've heard anything there, and what you think that might do?
Yeah, so the SALT limitation, for those of you that aren't aware, limits your deduction for state and local taxes, which includes real estate, income, personal property taxes, to $10,000. And that's why a lot of us aren't itemizing anymore, is because we aren't exceeding the standard deduction of $29,000 married, filing jointly, because we're starting at $10,000 for taxes only. A lot of people are pushing for that, and there were a lot of promises made last year on the campaign trail by both parties about trying to get rid of that. For most people, that will definitely allow them to itemize, allow them to get a bigger deduction. Unfortunately, it's also an AMT add back. So for IC people that are floating between $400,000 or $500,000 of 1,000 of income all the way up to 800,000 of income, get stuck with AMT when they were taken back prior to 2018. So it's a give and take, really. You get the deduction if they bring it back. And I definitely think there's push for it. I'm not really sure if we're going to go back to that, though.
Okay. No, that's a great observation, and thanks for the AMT comment there. I had forgotten about that, and that was bringing back nightmares to me. So let's stop talking about that.
All right. Next item, right below bunching, is a donor advised fund, and those can really go hand in hand. Donor advised fund allows you to put a lot of money into a fund, get a charitable contribution up front, and then you can slowly disperse those, or the fund can slowly disperse those funds annually. It doesn't have to be all at the same time. So you're, in essence, accelerating your charitable contribution deduction. And most funds are set up to take both cash and securities. So if you had appreciated stock you wanted to donate, that would definitely be a great tool to put in the option to contribute to the donor advised fund. What's great about appreciated stock, if you donate it to the fund, your donation is based off the fair market value of the stock. So you don't have to sell it and recognize income to get the benefit. The only downside is, though, the deduction is limited to 30% of your adjusted gross income. So you have to, you can't just wipe out your entire income by donating appreciated property.
But that carries over for a couple of years, though, doesn't it?
Yeah, absolutely. You get a 5-year carryover on contributions you don't get to take advantage of in the current year.
Right. Perfect. Perfect. And we definitely have a lot of clients that utilize the DAFs for various reasons. Those that are looking to make an impact with their philanthropic dollars. A lot of people with a big tax year and gains will take advantage of that all at one fell swoop. So it's really helpful. And I'm getting some echoing here, so I think I'm going to stop talking for a minute and let Jim come back on.
Okay, thank you, Chris. Next couple items on this slide, securities versus cash. I touched on that really quickly, just getting the benefit of the fair market value without having to sell it. And then QCD, a qualified charitable distribution. This allows taxpayers who need to take a RMD from their IRA, who don't need the funds and were otherwise charitably inclined, to do so via QCD. So there are a couple requirements. One, you have to be at least 70 and a half. Or sorry, 70 and a half to take the QCD. And you're limited to I believe it's $105,000 this year is the most you can do in a QCD. So what this does is the money comes out of the IRA, and normally a distribution from an IRA, shows up as taxable income. This is going to bypass that, and it does not show up as taxable income. So you can't otherwise then claim the deduction on your Schedule A as a charitable contribution because it's being excluded from your income.
It's a great way to use your required minimum distributions if you technically don't need the cash yourselves to live off of. This is a really great planning strategy and something that we really, really enjoy doing for clients because it allows them to make a big impact with their tax-laden IRA assets.
All right, and then just a picture of a couple life events that you want to make sure you're discussing with your tax preparer. When you get married, everybody always asks me, should I file married filing separately, married filing jointly? 9 times out of 10, there's definitely a tax benefit to filing married filing jointly, especially when you have one earner who makes more than the other. When you have a situation where they both make almost identical income, tax savings go down. But when there's a discrepancy in wages between the two spouses, one spouse that makes more is actually taking advantage of the other spouse's lower tax brackets. So as part of my practice, when I'm preparing someone's return, we always run an optimizer to show them the benefit so they understand why it's beneficial to file married filing jointly, or in some cases separately. In Massachusetts, we're going to talk about this later. Some people are filing jointly federally in 23 and separately in Mass in 23. For 24, that's now going to be, you have to file the same way in Mass that you were federally. Birth of a child, babies, great, they're expensive. The government realizes that, and they try to give you a small tax credit. The credit is phased out when your income starts to exceed $400,000. And then once your child reaches 17 years of age, you're no longer entitled to the full $2,000 credit. It drops off to $500. And the third life event is, going out and buying your first house, or any house, right? When you go from rental payments are deductible on your Massachusetts return, but they're not deductible federally. You go out and buy your home, you now have a very expensive mortgage, you get very expensive property taxes, and hopefully the interest and taxes are then going to be deductible on your federal return. Another great thing to think about is when you're a homeowner is with the Inflation Reduction Act that came out about 3 years ago, a number of expanded energy efficient credits were part of that act. So I try to make it a point to ask everybody I know that when preparing their retirement. Hey, did you do anything to your house this year? New windows, new doors, siding, roof, anything that improves the energy efficiency of your home, because you could get a credit. You know, if you put in mini split, heat pumps, anything of that nature. So always think about, you know, hey, have I done anything to my house in addition to just buying a house that might be eligible for a credit annually? Next
Great
slide.
point. Thank you.
All right, so you've done well. You put some money in a portfolio, brokerage account, and then the question is, how do we make sure we're not paying too much taxes on that? A couple options are available. Tax loss harvesting. This is a situation where at the end of the year, you would reach out to Chris or whoever your financial planner is and work on identifying stocks that are at a loss, that are worth selling. Chris can get into a little more on the reason behind why you would want to sell a stock at a loss.
Yeah, so in that instance, at the end of every year, throughout the year, we're often paying attention to this. If we have a really treacherous period right now, we might actually try to take advantage of some losses for folks. It might be a position that you want to hold long term. We could sell it, capture that loss, and then replace it with something else for a period of time, or simply hold pending and buy it back after 30 days. We want to make sure that we don't have a wash sale, which would be selling it, trying to get the gain, and buying the same back within 30 days. That would be a bad rule or a bad result. So the tax loss harvesting is definitely important, particularly in down years. You really don't want to get hit with a significant capital gain on something that you could have stepped the basis up on if you sold it. So we always pay attention to that sort of stuff. And it's also important as it relates to mutual funds that have embedded capital gains in them that make distributions. So we're trying to always do an analysis at the end of the year on those as well, to make sure that we're not going to just capture a capital gain distribution when the fund itself is down and we could have taken a loss.
Awesome. Yeah, another thing to touch on with wash sales is, the wash sale rule is a 60-day window. So it's 30 days before the sale, 30 days are after the sale, and that loss is disallowed. And in addition, other exercisable events that you might not even think of can trigger a wash sale. So if you have restricted stock units that you exercise or options that you exercise, because you have the ability to determine when you exercise those, that if you sell the exact same stock of your company and then you exercise these options and acquire these shares within that 60-day window, you've triggered a wash sale. And most people don't even think about that.
Great point.
All right. And then, everybody always talks about long-term capital gain treatment. So what is that? Long-term capital gains is when you hold a capital asset, such as a stock, for over a year. Short term is when you hold it for 1 year or less. And what that means is you're getting these preferential rates. So if you are in the top tax bracket, 37% ordinary income, your capital gains are going to get taxed at 20%. If you're in the almost any other bracket except the lowest tax bracket, you're going to get taxed at 15%. If you're in the lowest ordinary bracket, your capital gains get taxed at 0%. So I believe that married filing jointly up to 80,000 of income. So tied to inflation, so it's a little more than 80, I believe. The capital gains rate is 0. And then in Massachusetts, they recently changed the law. So it used to be 12% for short term. It's now down to 8.5% for short term, but long term in Massachusetts taxed at 5%. So it's very beneficial to pay attention to the holding period before you sell off stocks. I mean, of course, if the appreciation's there and you don't think it's going to last, you do what makes the most sense for you. But to the extent you have the ability to hold something until a year has lapsed, definitely do it for the tax savings. And then outside of your employer retirement plans, what other advantages do you have that you can take? What other, retirement or deferral plans can you take advantage of? We have your traditional IRA. In 24, your traditional IRA limitation is contribution limit is $7,000, and it stayed the same for 2025. there is a catch-up provision for people who are over 50 that can contribute an additional $1,000 to the traditional IRA. Now, the traditional IRA, if you already have a retirement plan and you make more than, I believe it's like 240,000 of income, give or take, if you're married filing jointly, that traditional IRA is going to be non-deductible. If you do not have the ability to contribute to another plan, if your employer doesn't offer a retirement plan, then you would get that, you'd be able to get a deduction for that contribution to the IRA, up to $7,000. Some people do make contributions to traditional IRAs, even though they know they're not going to get a deduction because they're trying to create basis. The next item, the Roth IRA, it goes hand in hand with this because anybody can contribute to a Roth IRA if they're below the income thresholds. Income threshold being, hold on one second, I don't have the number. It's almost the same as the traditional IRA income limit, excuse me. But if you don't contribute to a Roth IRA and you still want to get the advantage of contributing to a Roth IRA, there's a concept called a backdoor Roth conversion, which involves contributing to a traditional IRA, not having any deduction for that. So you now have basis in your traditional IRA, and then rolling that over or converting that into a Roth. So that's a backdoor mechanism of making a Roth contribution, even if though you exceed the income limitations to contribute to a Roth IRA. Then we also have a SEP IRA. So for anybody that is self-employed, if you have a side hustle or any other, your own business, and you want to set up a retirement plan, a lot of, one of the better options is a SEP IRA. SEP IRA is great because it allows you to contribute up to 25% of your earnings. It's capped at, I believe, 70,000 this year. If you, another alternative to a SEP IRA would be a simple plan. You can contribute up to 100%, up to almost $14,000 in a simple, but I have a lot more of my clients contribute to a SEP than a simple, just because their income is much higher and they want to get a much larger deduction. And then, you can also do what's called an individual, or it's also called a solo 401k. You can set up your own 401k plan for if you're just a sole practitioner. The difference between a solo 401k and a SEP IRA is once your plan hits a certain size, there is some administrative reporting required. That's why a lot of sole proprietors or self-employed individuals use the SEP because less administrative burden. But when you have an individual 401k, you can take advantage of other components like a match and a profit share, so you can definitely maximize the 401k even with less income, less earnings. And we touched on capital gains, just trying to get the lowest tax rate available, and then just estate taxes. Federally, a lot of us, I myself am never going to hit that estate tax federally. Massachusetts, though, with the way properties appreciating, you never know if you're going to get sucked into the mass estate tax. It's currently about 2 million, I believe, is the threshold. And
it is 2 million per spouse.
Yep. So people are getting there a lot faster than they expected, just because you own a home on the Cape, you're probably 3/4 of the way there right now. Chris, anything you want to add on estate taxes?
Yeah, I would simply say that this is an increasing area of planning and concern. We're happy that the exemption increased from $1 million to $2 million a year or so ago, but it still creates a conundrum for wealthy folks where they've got tax ramifications from just being in Massachusetts.
Awesome. All right, and just some recent changes in this at the state level, and I think I've touched on these, but I'll just touch on real quickly again. Rate decrease for short-term capital gains went from 12 to 8.5%. Deduction for contributions to a 529. If you're contributing to a 529 plan, you can get a deduction in Massachusetts. You can now deduct charitable contributions in Massachusetts. That hasn't been around for, I think, since '03. You don't need to itemize federally. So if you're not getting the benefit federally because you can't itemize, you can still get the deduction in Massachusetts. The one caveat is though Massachusetts's deduction is based off of contributions of cash. You aren't allowed a deduction for household goods. So, you know, I pack up a bag and I take it to Goodwill or wherever. I'm not going to be able to write that off at the state level, unfortunately. And then the new estate tax credit of $99,600. That's just, you know, if you do the math backwards on the credit, that's what gets you to that $2 million exemption amount. And then the last item is joint filing requirements for married couples starting in 2024. So if you file jointly federally, you need to file jointly in Massachusetts. There are exceptions though. If, for instance, one spouse lives out of state or one spouse is below the filing requirement level, but in general, they want spouses filing jointly because people in 23 were, you know, filing jointly federally and then separately in Mass in order to avoid the new 9% surtax, tax.
Mm-hmm. Excellent. Great. Appreciate the time and thought that you've put together here on this as always, Jim. I don't see any current questions. To the extent that anybody does have a question, by all means, reach out to either Jim or myself. You see our contact information here. We really appreciate you spending a portion of your day with us here at 12 Points. Jim, again, thank you, and we'll let everybody get back to it.
All right, great. Thanks, Chris. Thanks, everyone.